Hey, once again, everybody. My name is Lori Page, and I lead the advisory team here at Sound Wealth Management. My uncle updated his Facebook status yesterday with something that I think many people are feeling right now with yesterday's Russian invasion of Ukraine and on the tail end of an unprecedented global pandemic. It said, "I'm tired of witnessing once-in-a-lifetime historical events." When you think about it, we have in our lifetimes borne witness to some of the most unprecedented events in history, from the novel coronavirus pandemic to the Russian invasion of Ukraine, from record stock market highs to unimaginable advancements in technology. Through it all, one thing remains constant: that we were here to witness it together. As we're always actively working to stay informed on all events that will impact our clients' portfolios, I had the opportunity yesterday afternoon to be on an economic update call with JPMorgan Chief Global Strategist, Dr. David Kelly, during which Dr. Kelly shared his insight on the global investment implications of the Russian invasion of Ukraine. I'd like to share with you a few of the key takeaways from Dr. Kelly's discussion. As your trusted advisors, our job is to try to make sense of these events in terms of how they impact investments. A couple key points, first of all, on the sanctions being imposed. Substantial financial sanctions are being imposed, but important sanctions, specifically turning off the pipeline and removing Russia from SWIFT, were purposely omitted, and many people are wondering why. So removing Russia from SWIFT, which for those that don't know is a global system allowing for the exchange of money between countries for import and export. So removing Russia from SWIFT will ultimately stop gas supply from most of Western Europe. And this is important for Western Europe to keep, as they don't have energy independence nor oil reserves on their own. As we can see evidenced by the stabilization that we saw in the markets by the close of U.S. trading yesterday, markets are starting to sniff out the most logical next step, which will most likely be some kind of negotiation. This being the case, global commodity prices are unlikely to continue to soar, and money won't need to flood into the U.S. if energy isn't disrupted. So how does this affect fiscal and monetary policy? Well, it could potentially be a hit to consumer confidence. It could also potentially increase the possibility of additional fiscal stimulus, although most likely not in the form of corporate tax breaks. We can also expect to see most likely 3 rate hikes of about 25 basis points or so from the Fed in the early portion of the year. Expectations for the U.S. economy: JPMorgan is predicting 1 to 2% of GDP growth in the first quarter. They're expecting that Americans will continue to spend money, as Americans have a tendency to do this to soothe their nerves. They don't expect this to stop. However, employers may start to slow their hiring, but they expect that there will still continue to be more jobs available than workers available to fill them. JPMorgan also predicts that there will be U.S. GDP growth of about 5% throughout the second quarter. The bottom line here is that we may still see some increased inflation, but the economy will gradually move past this. So what are the investment implications for you? Well, there's always unpredictable shocks to the market. Your best defense is to take this and to be broadly diversified. Other investment implications: we expect there to be a greater investment in U.S. oil in the short term. And why is this? Because the U.S. has a lot of allies in Western Europe. And as I mentioned earlier, Western Europe doesn't have the types of oil reserves that we have here in the U.S. So they're going to need to rely on some of their allies like us here in the U.S. So you'll see some of that investment in U.S. oil in the short term. But long term, we can expect to see a greater investment in alternative energy sources globally. We can expect there to be a risk premium built into oil prices and expect this to stay on the high side in the near future. However, The price of oil, you should know, should not cause a recession in the US, since 2020 we have been a net exporter of oil, and gas only makes up less than 3% of consumer spending here in the US. So this just proves the worldwide importance of energy independence, particularly for Western Europe. So what do you do to hedge against some of these risks? Well, there's a lot of potential risks right now. Inflation, market risk. Will Putin continue to take more drastic actions? And the list continues to go on. So rather than hedging against a specific risk, your best defensive action is to broadly diversify your portfolio against a variety of risks, and be sure to look carefully at valuations and actual economic values of the things that you're investing in. For a more in-depth discussion as to how this specifically impacts your portfolio and your investment needs, please feel welcome to contact our advisory team at 941-932-4822 or schedule your no-obligation consultation online at www.soundwealth.net, where Sound Wealth Management is more than just our name. We look forward to working with you now and in the future. Have a great day, everybody.